We're live.
This camera's going to be good, so.
Hi, Kevin.
Hey, how are
I'm
you?
sorry if I didn't tell what you bought.
I was.
Never discreet.
We're live.
Hello.
Yes, we are.
Okay, this meeting of Council Rock School Board Finance Committee. We're gonna take attendance, so to speak. We're gonna go around the room, introduce yourself. I'm Wendy Thomas, Chair of the Finance Committee.
Jerry Grubb, Board Director.
Mike Thorwald, Board Director.
Joe Messina, CREA.
Andy Block, Board Director.
Kyle McKeskey, Board Director.
Matt Fedderson, IT Director.
Robert Frazier, Superintendent.
Kevin Carpuck with Cornerstone Advisors Asset Management.
Mark Violet, Board Director. Bob Reiner, Director of Business Administration.
And we are accompanied this evening as well with a member of the public from the press. We have Chris English from the Courier.
Hi, Chris. Okay, so on our agenda tonight, Bob's telling me that you guys have a copy of the presentation, but for those who are watching on YouTube. We're gonna go over some information from our investment consultant, after which we will take questions if anybody public shows up, but some more questions, so that then you can get out.
Thank you.
And then Bob's put a great deal of work into the first draft of the budget, and we will go through that. And those are going to be our two main agenda items. Okay? Okay, Dr. Frazier, I told you would like to make a comment before we start our agenda.
I would. Thank you, Ms. Thomas. On behalf of the administration, the school board, and the entire Council Rock School District, we would like to extend our condolences to the Longo family. As this past Friday, Megan Villanella, the former Connie Longo, a 2000 graduate of Council Rock High School, tragically lost her life. Her parents, Derek and Connie Longo, were longtime teachers in the Council Rock School District. Certainly, there is no pain more difficult than tragically losing a loved one, as happened with Megan this past Friday. Megan was a beloved daughter, sister, as well as mother. Our heartfelt thoughts and prayers go out to the entire Longo family during this most difficult time as they grieve the loss, again, of the former Megan Longo, 2000 graduate of Council Rock High School. Thank you.
Let the record show also the, yes, the word no, right. No problem, just when you on the, okay. So on to the first item.
Just want to introduce Kevin Carpuck. Everyone around the table, I'm sure, knows Kevin from Cornerstone, also a alumni of Council Rock School District. But we have begun the more detailed process and prepared everything we were going to prepare to be able to change our investment strategies and how we're going to handle that. I think it's an appropriate time where interest rates are now rising, and we just want to go over some of the basic issues with you tonight, so we get a shake of the head and you know what we're going to be moving forward with. 2 or 3 weeks ago, we moved $20 million to Wilmington Trust Bank for them to invest in marketable securities, as we discussed previously. But Kevin's just going to go over some of the basic things and talk about our investment program and get you guys up to speed, and just so you all say, yep, we're ready to do this and let's do it. So, Kevin.
Thank you, Bob. And thank you everyone for the time today. Looking back about a year, the foresight of the board to actually set up the policy and go through the manager search and selection process while interest rates were flat on their back proved quite prescient, because what we've been able to do over that year is negotiate TD's crediting rate up while interest rates have started to normalize. And now as interest rates have risen and there are better opportunities for income out in the market than there are in the bank, we can actually implement relatively quickly. We don't have to go through the process again. So quite frankly, kudos, and the foresight was excellent there. If we want to go just to the next page, what we What we were hoping to do is give everyone a quick update on where the general fund balances lie as of just a couple days ago. And we did round the numbers off because there are lots of cash flows on any given day. And we have a general fund balance about $23 million currently at Pliget, at Wilmington Trust, a hair over $20 million, and at TD Bank, $62 million. And TD Bank, and I'll mention this in just a second, is where the cash flow, where the day-to-day operational cash is pulled to pay the bills. To give you an idea, when Bob mentioned that we moved the cash from TD over to Wilmington Trust just about a month ago, given where rates were, what we worked out with Wilmington Trust was that they would buy a 30-day zero coupon US Treasury bill. So they put $19,999,000 and change to buy $20,007,000 worth of the bill. That did mature today at $20,007,000, and Wilmington reinvested in a 1-week T-bill today. I asked them to do that, just knowing that we had a conversation tonight. Wanted to make sure that if there were any questions, those were answered before anything bigger was implemented. If we go to the next page, what we took the opportunity here to do was just take a snapshot of the three different providers we're utilizing right now. And you can see TD Bank right now is crediting about 0.55%. From that, they do take their monthly fees. So for example, for ACHs and for different services they provide the district. So at the end of the day, they're yielding 0.5%, so 50 basis points. That was the number we negotiated several months back, and as we'll look at in a second, it was significantly above where the market was for short-term money at the time. So in terms of security, in terms of risks, and that's always the most important thing. We want to get yield, but we also want to know how we're secured and what risks any of these we are posed with. So security, obviously up to the FDIC limits. We do have coverage on a $60 million portfolio. That doesn't really account for a hill of beans in total amount. And then there is Act 72 collateral, which in a segregated account that's held at the Bank of New York Mellon, or BNY Mellon, TD has pledged securities, which are asset-backed credit card receivable bonds, that in the case TD was to run into trouble and quite frankly go under, that would be the security for the district. While we don't love those, we would much prefer owning treasuries or agencies. We're becoming more comfortable based on the fact that we've taken a step back. Well, number one, there isn't a whole lot we can do about it. We're talking about a several billion-dollar portfolio in total. But we've taken a step back and said, what would be the likelihood that TD Bank, which has historically been a conservatively run bank, get into that much trouble that we would have to dip into those into that collateral, and we're comfortable with where we are right now. If in the future that changes, we can move assets to other areas to protect that. But the main risk we look at now is that the crediting rate, while we go back and talk to the TD folks regularly, the crediting rate historically has been tied to some market rate, whether it's 6-month T-bills or LIBOR or something. When rates came down to virtually zero, the bank had to set what's called a non-indexed rate. So basically, we negotiate with them and they pick a rate and they pay whatever they pay. Well, for the past year, that's been excellent. We've been getting above market. Well, they're slowing down those rate increases. So now the market buying actual securities is giving us an opportunity to make more money. While we will be going back and talking to them about getting back onto that index rate, right now they're not ready to pull that trigger. So what we did in effect was move money out of there to where we think we can get a better yield. And the other risk is that, again, if that collateral was to freeze up at the same time TD got into serious trouble, that would be a risk. But that would be a significant black swan event in just across the board, everybody would be in some pretty serious trouble.
So have you done any kind of research that shows a period of time, going back however long, where that event has occurred? 2008, 2009, was there, like I remember Orchard first, when everything was locked up. So
So
these bonds affected like that?
these bonds were not affected like auction rate bonds because the Fed and the Treasury Department stepped in immediately in the asset-backed security market and basically gave unlimited guarantees there. So while we did go back and look and we were trying to stress test it, we said, that's weird. They were still trading at par all through the bad times. And then we looked at the calendar and said, oh yeah, the government stepped in. So while it would be a lot more difficult based on regulations that have come down since 2008 for the Fed to provide that type of liquidity, we have to believe that if that market freezes up because it's such a crucial part of the financial system, that there would be some kind of backstop there. But there hasn't been a time that we can point to that says par became 80 cents on the dollar.
Right.
And there are slight fluctuations over time based on interest rates, but nothing where there was a significant shock there. Yep, no problem. If we want to move ahead to Pliget, what we did here was we showed where the current crediting rate is. And when you think about Pliget, those top three bullet points, Pliget, Pliget Plus, and Pliget I, you can think of like a mutual fund. The more money you have, the less you pay in fees. And the Pliget I class has higher minimum investments and also has more restrictions on how much you can move in and out. But for that, you do get paid slightly more, 0.6% versus 0.45%. And as we discussed last year and even prior to that, what you'll notice is those fees are starting to move up. Pliget had waived and deferred a lot of fees while interest rates were low. With right in the trust document, it says if they did that, for up to it's either 3 or 5 years, they could defer them and then recoup them as rates come back. And that's why I noticed the current yields are not as responsive as the market has been. And then I included Pliget Prime here. The Pliget Prime, unlike the other Pliget classes, avails itself to the Act 10 securities, so commercial paper and all that good stuff. The district has no money in the Pliget Prime investment. While there might be a time in the future, and we've discussed this as part of the policy, there might be a time where it makes sense to entertain some of those investments. If I'm going to get paid 0.2% more per year to add credit risk, someone else enjoy those riches until something bad might happen. So again, we're in those pre-Act 10 securities through the traditional Pliget portfolio. So the security there are underlying investments within the trust, and they are relatively high, or they are highly liquid. And there's $25 million worth of insurance through the custodian. You'll notice a couple pages back that the current balance is right about $23 million. We'll be looking to keep that number down below that insurance. Obviously, come late summer, when balances get high, we'll need to move money around and make sure. But also, if the Pliget crediting rate continues to lag, there will be opportunities elsewhere. So the risks, and again, these are non-prime risks because we don't invest in prime. We didn't get into those. If we do have balances over insurance, or if the portfolio faces catastrophic type drawdowns where they would have to sell some of their underlying securities, they could break the buck, so to speak. Again, that hasn't happened in the past, and it would be a really negative event and a multiple standard deviation event. So looking at Wilmington Trust, and what we did here, Wilmington Trust for management and custody is charging the district 0.08% per year. That fee was negotiated through the manager search process. But what we included here was the different yields right now on Treasury securities. Wilmington Trust is going to have the ability to buy and sell securities that we'll discuss the ranges there that go from 1 day to about 3 years, a maximum maturity. So the security of Wilmington Trust, they have over $125 million of insurance per loss. So we have plenty of runway there, but also that the underlying investments are not commingled. So where we have money at Fliggett, we're invested with just about every other municipality in the state, right? So if and this isn't true, but let's say Philadelphia had $5 billion with Fliggett, and that made up a big portion of the portfolio, and Philadelphia said, we need all of our money. That's what I'm talking about, a big drawdown. Here at Wilmington, the actual security, so that treasury bond we owned was in the name of the district in a separate account. No one could force Wilmington to have to sell other than the district. So we're not affected by that. Well, what are the risks? A liquidity mismatch, because this will be priced daily. If we put too much with Wilmington and then Bob calls and says, we need to pull $5 million out today, we may have to sell at a loss. And we've kept that number low in terms of total dollar amounts to avoid that from having to happen. And another is the short-term mark-to-market fluctuations. We own the bonds, so we can always put them in our back pocket and own them until they mature at par. But on a month-to-month basis, when you look at the financial statements, there could be some movement. We had 20 million, and now we have 19,990,000. We didn't lose any money. That's just a short blip.
That means if you sold it that day, you sell it all.
Right. But since we're not going to
Maximum maturity is
3 years. Yep.
And this is where, just so we look back to the three holders of money, your TD Bank is your liquidity location.
Yep.
So you would have to, where you're holding, as you said, about $60 million.
Mm-hmm.
So that would have to be a pretty long and unforeseen and really catastrophic mismatch.
If we were real old with our cash flow projections and trying to tie every dollar up till the last minute, that would be more concerned. Right now,
You're not that old.
we're not, I don't want to be.
You're conservative, I appreciate
He doesn't want to
that.
be old.
Exactly. You're trying to be bold.
He doesn't even
not
like
to
that
be
word.
bold.
He doesn't even like the word.
You guys aren't going to do anything to me if I get 20 basis points higher than if I didn't do something. But if something bad would happen, you wouldn't have to scold me.
What is the maximum reasonable swing?
Yeah.
10%, 20%?
Oh, no. It would be, if we were at the longest we could go in terms of maximum duration.
At the 3-year mark, is what you're saying?
Yep,
Okay.
and rates moved 2% overnight, we would lose 3%. And so
Of 20 million.
right. So, but that would be overnight. Tonight we go to bed and the Fed funds is at 0.66. Tomorrow morning, Janet Yellen, that morning decides to.
Why would it have to be like that? Why couldn't it be that they lose half a point tomorrow and half a point the next day and you're 3 points down in a week?
Right, well, so that would be equivalent of, it happening overnight. What I'm thinking more is if it goes 25 basis points next week, 25 basis points in 6 months, I'm earning interest over that time. So the income is covering some of those fluctuations.
So you're getting a short maturity. It used to be a 2-year bond, now it's a 1-year bond. It takes a year to happen. So you're one down curve.
Yep, and we'll be getting there. Yeah, and I apologize. I throw around basis points like everybody's a nerd like me. A basis point is 0.01%, so 100 basis points are 1%. So
He calls them bit during the day.
yeah. Okay, are you saying I'm even nerdier during the day?
I don't know what you said.
So
You
yeah, and we will in just a couple of slides here show some examples of what you can earn if interest rates don't move, and kind of what would happen after a year if rates were to move 1%. So the long and short of those last couple of slides is we have reviewed all of the cash that the district has. We're comfortable with where it is. We think compared to a lot of folks, we've been hearing, Prime is gathering a lot of assets. A lot of people are taking some risk with their money compared to most other municipalities. The district is in good shape. It's about as, without putting it all, without putting $100 million into Bob's mattress, I'm not sure that the yield trade-off at this point, getting any safer would make a lot of sense. All right. Let the record show Bob isn't going to put anything in his mattress. So we did want to just take a second. Here's some fixed income concepts. And the two important things, and we already hit on it, are maturity date. I buy a bond, unlike a stock, which can go up or down 50% in a day, right? A bond I buy, and it's all math. I know when the maturity date happens, I'm getting my money back. And these are government, and I can say that with confidence because these are government-backed bonds. If it was, a small company, high yield, I wouldn't have said what I just said. But then the duration, and I mentioned that before, duration is the sensitivity of a bond price to changes in interest rate. So you can think about it like this, like you're on a diving board. So if you step one step onto the diving board and you jump, you get just a little bit of movement. But if you go all the way out to the end, and that would be where long bonds are, and you jump, you get a whole lot of movement. So I hope nobody's imagining me standing on the diving board right now. But so where the district is at, if we weren't being recorded. So where the district is, so out here you have 30-year bonds, right? So they move, if interest rates move a little, you can lose 10 to 15% in no time. The district is nowhere near there. It's really short and virtually, there is fluctuation, but nothing compared to longer term bonds. So very quickly on page 7, just to show you where, my page 7, where the top left is the long treasury curve, just so you can see where rates are. And the blue line is current, the dark blue line is current, the green line is at the end of the year, and then the light blue line is about a year ago. So you can see rates across the curve have moved up from where they were. They're basically at the long end back to where they were at the beginning of last year. At the short end, because the Fed has raised rates, and it looks like there's a 100% chance basically that they're going to raise rates again next week, or in a couple weeks here. Rates have moved up on the short end. And to give you an idea, on the right side here, it'll just give you a snapshot of where we were a year ago versus today for a 1-month bond. So you buy a bond and you get your money back in 30 days, all the way out to a 3-year bond. You buy it, and a year ago you would have gotten 1% or 0.99% per year. Now you would get 1.59%. So straight across the curve, you've seen increases of 0.3 to 0.5%. And just since the third one, we put this together, that 3-year number has gone from 1.59 up to 1.65.
So this isn't that stale. I mean, these are 5-day-old.
Yeah, absolutely. And an interesting thing to keep in mind is, just like the stock market, the bond market doesn't sit around and wait for the Fed to do something. They're already pricing in that the Fed's going to raise rates. So that's why we're more comfortable that when we get moving in the short term, there won't be an immediate negative reaction. It isn't like when the Fed announces a rate increase, all of a sudden we lose money. Most of that's been priced in. And this is an eye chart, but just this is what's called the Fed dot plot, and all of the yellow dots are where different members of the Federal Open Market Committee think rates are going to be next year, a couple years out, and longer term. What we wanted to share with you here was that the red and blue lines, which are a little bit difficult to see on the screen here, is where the market thinks rates are going to be, and the greenish line, which is above that, are where the Fed, where the median of the Fed expectations are. The interesting thing is, for the past 5 years, up until recently, the Fed would move down towards the market. The market's been saying rates aren't going to go up, and each time the Fed got together, they would lower their expectations. Over the past 90 days, the market actually has started coming back to the Fed and saying that we think there's room to raise rates here, which is good for, obviously for the district, for the earnings.
Well, on the investment side.
Right.
Right.
Oh, yeah.
And we borrow too. So,
Yeah.
exactly.
Yeah. Well, that's.
So this is just a big setup, isn't it?
Yeah. Well, I get to get out of here before rising rates become bad.
Spend 20 million.
Mark and I are still those.
We're making 10 basis points on borrow $20 million.
So here what we did and was we tried showing some examples of what happens if interest rates move. And these are just examples. The top boxes, if we put all of our money into 3-month T-bills or all into 6-month, and we included all into 3-year bonds. We're allowed to own 3-year bonds, but if you look, that duration's 2.5, and our guidelines have a maximum of 1.5. So that 3-year bond, 100% actually would be outside of our bounds. But I didn't want to include that just because when you look down the first 2 boxes in yellow under the income plus change in market value, if rates don't move in a year, the district would be about $150,000 better off by going out 3 years, right? $150,000 certainly is nothing to sneeze at. But then I said, what if rates increase 1%? Today, the day after we buy everything. Well, when you only have 6-month T-bills and they are about as close to the short end of the diving board as you can get, the district at the end of the year would still show a market value of $20,088,000. The actual underlying bonds would show a loss of $80,000. Again, you didn't lose anything; you just called them to maturity. But then you get out a little bit further on that diving board, and you see the 3-year bond, even including the interest we would collect, would be about $180,000. So about a 1% total mark-to-market loss. Again, since we don't have to sell it, we are less concerned with that, but did want to put some numbers so everybody can see it and understand. And then underneath we said, well, what if we just equally weighted, so 20% into 3-month, into 6-month, 1-year, 2-year, 3-year, and then we said different risk parameters of the 70% 3-month and 30% 3-year. And what you see there is, again, on the bottom line where you have 40% of the money in the 3-month T-bill and 60% in 3-year treasury bonds, that is at the far end of duration. I'm not allowed to go any further. Wilmington Trust isn't allowed to go any further than 1.5 years. Well, if rates were to move immediately 1% again in that mix, we could be looking at about a $50,000, again, unrealized loss. So, net, can anything happen? Absolutely. Could the Fed over the next year raise rates 1%? They could, but we also think that that'll be staged in, so we'll be earning income and being able to reinvest at higher rates as well. When I say we, again, we hired Wilmington Trust to put these portfolios together, so they will be trading the portfolios. They're going to own some real short things. They're going to own some 2 or 3-year bonds where they think it's appropriate. And again, we have the bullet point.
I don't understand, I'm sorry, I'm not the only one, but we invest $20 million in a 3-year bond. And at the end of that, what's the 19,118? Is that how much money I get at the end?
No, that's after 1 year. So if
After 1 year, I close the bond out after 1 year, I would only be worth 90.
And rates went up.
Okay, if I hold it for the full 3 years, I get my $20 million back no matter what.
yeah, you get it right. And
Will I have earned any interest during that time?
$318,000 per year. So you.
So as long as I do the length of the bond that is stated, I get the income plus column.
Mhm.
Thank you.
No problem. Yeah, and again, Bob made the point earlier, if if we were in a position where he might call and say, I need 5 million of it, I need 10 million of it, this would be a lot different conversation, but this is a, long-term, as if things change with fund balance, obviously we'll adjust this and adjust the mandate, but we are, we're comfortable with this, but we wanted to put some numbers on the table so no one got a report in 6 months and said, wait, what happened here?
So this is kind of tied into later, because we budgeted to use some of our fund balances, and if interest rates are going up, it costs us more to borrow money, maybe we would be more in a position to, I'm sure we're gonna have some minimum amount that would be in there, but I don't know that it's completely realistic to say that we wouldn't need some of this money.
I will tell you, that right now it's $20 million of, what's our total amount that we have to invest there. Yeah, so this would be the last place we have to go for our cash. I am very comfortable with where we are right now and where our cash flows are. I'm gonna tell you, I'm not gonna be putting our cash flows out real far. Will we ladder investments? Yes. And as the plan gets better and more mature, it's gonna look laddered as opposed to just the start. And I'm very comfortable with this. I guess that's why.
I look at it this way, if I think of it as a pool and wave machine, there's the TD Bank has most of the action of the wave somewhere in the TD Bank. That's where money's coming in and going out. Beneath that, you have the Pliget space, which is relatively stable, but a little affected by what's coming in and going out. Because you will, as you said, you're going to get large influx of money. You'll have to put some in there. But that water down deep in the pool is what we're looking at here. It's the water that really isn't, it's not going to be subject to much evaporation. It's not going to be subject to much action of the wave. If you had a long prolonged heat wave or something going on, you're right, then the water starts to evaporate and you're going to start potentially getting in it. But that's a lot of, the depth of that pool goes up to, in July, the pool is full. We collected that money. I'm sorry to live in the analogy, but that's where we are. So this is the deep part of the pool that you draw on the land.
I'm just saying our fund balance is 25 million, and we plan to use several million this year and several million probably next year. We had a 5-year plan where we were significantly, I don't know, it just doesn't feel like an impossibility to me. I guess it's just cash flow too, because you'll have your next year cash coming in, cash coming out, so you always have a certain amount of cash. But
on the 5-year plan, this is.
Lately, I'm less comfortable than I used to be.
If we have a 5-year plan, this is 2-year invested.
Well, 2 years,
Or 3 years.
well, 3 years,
What's the
and
blended?
it's starting to get.
So what's the budget that you see, what did Wilmington Trust say? Like, what's their proposal as far as, what would that maturity look like? Would it be more like a 1.5 reduction?
I think for the short term, it would be more like the second from the bottom, so the 1.1. So the rate would be about 1.1 as well, which is, significantly higher than the other options. But what I don't want to do is cause alarm as though this money can never be touched. I mean, these are short bonds that are going to be rolling off.
No, but if I have to touch this money, I can't afford to lose 100, that's how desperate I will be. You know what I mean? Like, right now, $100,000, we have the flow, whatever, but if I'm so desperate, I'm down to this money, $100,000 is gonna be a lot, so I'm just saying, just in the current budget environment, I'm a little bit nervous.
And you'll hear some of that tonight. I think she got a preview, maybe. What I'd like to, I guess, say with this is that you're not gonna just see Kevin once now. Quarterly, we're gonna get an update with a full evaluation of our investments, the performance and everything. I'm gonna ask Kevin to come at least the first couple quarters so we can go over the information in detail. Some of you are gonna look at it and start saying, I don't need to see this, but I think you're getting more comfortable with it because in the past, and Mark's been correct with this, is you guys let me run with it and we did what we did. It's gonna be much more focused and you're gonna have information in front of you in at least the first couple quarters, maybe several quarters, especially if you keep saying you want Kevin to come in. go over it, we'll evaluate our portfolio and see how it's performing. And I think we're all going to feel comfortable.
So the other piece for me is that we're looking to potentially borrow. We borrowed a lot of money. We have more money to borrow. That has a cost. As interest rate goes up, that cost is greater. So maybe we shouldn't be sitting on $100,000. Maybe we should be comfortable sitting on less and not borrowing so quickly. And it's just more complicated than just the investment side. I don't know. You don't look at any of the debt side. Yeah.
Just not a
But
financial plan.
I know it's not too, I'm just putting out there that the other side for me is that we have to borrow all this money and pay a lot of money to borrow it. So while I'm sitting and I'm doing better than I used to here, I'm spending twice as much to borrow that same money. Why wouldn't I just borrow it from why wouldn't I just use my own money? So,
And that, you know, between spending down and borrowing is obviously this group's mandate, but if that changed, right? I mean, if you were to decide to spend that 20 million and get to a point where it might be spent, this is a different conversation. So that would be guidance that via Bob, hopefully this group would, and not the earlier the better, but as much guidance out a couple of years as possible would be helpful. I know for Wilmington Trust in particular, how to structure portfolio.
So it's really hard for me not to comment on the details, but just conceptually, it's going to be clear. If the duration is 1.1 years, and if there's a 1% spike in interest rates, over that year, you're projecting that 20 million could be worth, we saw before the end of the bond period, 19,996, but if we weighted the entire duration of the bonds, it's the 20 million plus the interest rate. It's going to be clear with that.
Yeah. So
The extenuating circumstances are the spike in the interest rate of the market isn't calculating the rate, not periodic increases from the Fed, but what the market is baked into it, greater than that. And needing it faster than we think, and really within a year.
right, and even then, so that 50% 6 month, 50% 2 year, that would still be 10 million that in 180 days we're going to get back in cash. And this will be a continuous moving target. I didn't want to get into too much detail, but Wilmington will have some short-term CDs, and they'll have a lot of different things. The liquidity will be available, but if we were, we wanted to make sure that if we had to sell, that everybody kind of knew how the math worked and what the.
But you're not expecting to need $20 million in the next 14 months. I mean, and that's really what we're discussing. That
I think it's really wise that we got to have this discussion because interest rates have crept up. We had this whole discussion about our funding, how we're taxation, what that's going to look like, and there was discussion about this potentially being in it. You're doing 2 different budgets, so I think it's good discussion. And I'll say it's good to hear it from a third-party individual who can speak to all these things. You can negotiate fees for us, you can negotiate rates, and find appropriate entities invested, and not necessarily the people who are doing the investment for us and telling us how to work with it.
If anybody is a wonderful, I'll let you know.
Right, that's, yeah.
I mean, I'm pretty wonderful, but
still got that diving work there.
Bob, how do you feel? So this new structure, it's been a long time coming. This is my 3.5 year on the board, and I think we started the discussion in the first 6 months. How do you feel? I'm very little resistant at the beginning. How do you feel now?
I'm very comfortable with professionals we hire, and I have more comfort because of the professional group that I'm working with. They've demonstrated to me and given me confidence.
And even with the fact that the interest rates, so the interest rates have gone up, so Play really has offered us more attractive rates. But even if the interest rates had leveled, the work you did with TD Bank brought us, what, an additional $300,000 last year, just by that negotiation? Is there any room to negotiate fees with Plate, the fees?
Because it's a commingled product, there really isn't.
They never cut it from it.
That, yes. Now, what we can do is optimize, and that would be a Gail and Kevin thing, more so than it would be a board thing, is optimizing how much is in the I versus the class. You know, if you put too much in I, you only can take one half twice a month, so we wouldn't want to do that, but, right, it is the backup cash flow, but that would be how you get an effective fee down, is by optimizing the use of the cheaper share classes.
Okay. Kevin, thank you for coming, and I think you'll.
We'll do board comment and public
Can I
comment.
ask you? So Kevin, so I can finally vote on the church report. Do you feel, can you say that you feel as
God.
Really? This is it?
Am I being?
That's a lot of pressure.
Depends
A lot of
Depends on what
pressure.
he says.
Okay.
Don't-
What you all realize, it was 60 degrees tonight, and tomorrow there's a snowstorm, hell is freezing.
It's only in hell. So can you say with confidence that the district's money are safely protected, the fees are reasonable, we're getting a fair yield?
Absolutely, I can say that.
Yeah,
On the
he
record.
can say that, and when you're selling for 19 million and you lose money on it, he's gonna still say it looked like a fair deal on the citizen. We're the ones that
Seemed
want
like
to
a good
for
idea
it.
at the time.
It seemed like a good idea at the time. I'm not saying I'm against it, I'm just saying I'm more nervous now than I used to be. We have,
Well, you should talk about that. I mean, you have talked about it, but other people should, because there are other options. You can move that 20 million back into play, or 15 back.
Yeah, or keep it in short 3-month T-bills, right? I mean, the guidance to to Wilmington Trust, the policy is pretty rigid, right? But that doesn't mean that you have to change the policy. If for whatever reason everybody said, I want to buckle my chin strap and 0.7% is good enough, 20 million, the 3-month T-bills until the
So
gas.
from my perspective, back to your diving board analysis, you know, pretty, but it's functional. If you all stand at the end of the diving board, you have a great chance to go either really high or really low, but you move all at once. Diversification, you know, having people placed all along the diving board means you get a share of big fluctuations when they're positive, you're protected when they're negative. You know, it's just rational. It's what I do personally. I'm not going for huge gains, because if you went for huge gains, you go for huge losses. So it's just diversification. It's a practical solution.
Mike,
No, I'm good.
you're good with it?
I'm comfortable with.
Andy,
Love the analogies tonight.
you're good with this, because I think they asked for a nod and not a vote, but a nod that.
Yeah,
you're
yeah, I'm good. And seriously, nice work.
Kyle,
No.
Denise,
Kind of not it.
Good work, thank you.
Thank you.
anybody in the public have comments?
What is that beep?
It's my phone. It's a new phone. I can't figure out how to turn it in.
Okay, thank you very much, excellent work.
Well,
Thank you very much.
Thank you.
Thanks,
everyone.
Kevin.
Thanks, Kevin.
Someone get the 5 minutes.
Problem solved.
Can we get a break, are we good?
I think we're good.
Okay. Take it away.
Joe and Gary, these are public versions of the document. We're not going to go in a lot of detail, but you may want to have them for reference. Pass them over to Joe.
Sorry.
Thanks.
Here we go. Some things I feel like I just stood up here yesterday to talk about last year's budget, which was, I think you're going to find, at least I hope you find, that it was a much more difficult budget year than this one will be. This is a vital year. I don't want to put anything to a point where this isn't vital, but I do think the numbers are going to look a lot different with you here. But you are going to hear something from me about where I believe you need to end with the tax increase. And you're going to hear it from me very strongly and passionately, probably, because I've presented part of this once already. And I've been told there was some passion there. In fact, I've been told I was the most interesting man in the world. And by one of the principals. And then he said something about stay thirsty, my friend. I didn't understand it, but Mark, I thought you might. Okay. Anyway, as we go through here, I'm going to go over the budget. The budget is in the same format as it has been in the past. Please look through it. This is the first draft. I am not telling you this budget document is perfect today, but it is materially accurate as we look at the budget. Going to go over expenditures, revenues, expenditures, use of fund balance, and calculate the tax millage rate with you. Go through the analysis of revenues and the appropriation changes. So we're going to start off quick. This is the current budget that we're in right now. You will see that we have use of $4.3 million of fund balance. Something that I'm pretty comfortable with, around $4 million, as you know, or we do each year, is because of the revenues generally coming in slightly above the estimated revenues and the expenditures coming slightly below the appropriations. We usually create about $4 million of fund balance, about 1% on each side. I knock on wood and I hope that keeps happening, but that is just past experience. Where we are today, revenues are going up $7.3 million. I'm going to go over where they're going up. There's some good news for that. Expenditures are going up $9.5 million today. And right now, our fund balance that we're using, we would need to use if we made no changes. And this is with a full tax increase, is about $6 million. I'm going to explain that further, so don't be in shock at this point. It's not anything like that. That does have a full tax increase in it of 2.5.
And that 4.3 budgeted this year, you feel like we're going to be close to that, or are we going to be?
We're going to go over that. I'm going to show you.
Okay, great.
Go ahead. I'm not going to be precise, but I'm going to show you where we are. But, okay, current real estate taxes, and we're going to get into that number a lot. That number is $4.7 million higher this year than last year. Part of that reason is because our assessed values went up, and you're going to see all that. Earned income tax, we're going from $15.3 million to $15.5 million. I'm putting it back up where we got once, and then it dropped back down. So I believe it's going to go back up to the 15.5. Hopefully it's going to go up above that even further. Real estate transfer tax, that's huge news. That's saying that real estate's moving again in the district. And if you look at, let's go to page F3, and you can even look at some of the information there. If you look at the actual, 2014-15, our actual was $2.7 million. Last year's actual went up to 3.2. So you'll see that I'm moving it up
Still
to 3.2. You see that?
That's what it was.
Yep. Earnings on investments. You heard all about it. And it's not just because we're making maybe smarter decisions and going out on the yield curve. It's because interest rates are rising. At the end of this presentation, you're going to see our capital planning piece, which I'm going to go over with you too, and it's affecting that also. If you remember on Monday night, I was asked a question, and I wouldn't give an answer. I'm giving you an answer today, and I'm telling you it's an increasing interest rate environment, and that's going to affect what we can do. Basic ed subsidy. This is very important for you to remember. Usually I stick a number on there and I say, this is our hold harmless and they can't go below that. Remember that? It was always a hold harmless from the year before. If you remember the presentation I did before, the hold harmless now is from 1450. So let's go to this page and you will see the, I have $14.3 million in there. You know, I usually have change and everything else in the budget. But now they're changing variables on us up to the last day where they could change the amount you're going to get on June 30th because they keep changing the variables the actual value of the variables, not which variables are using, but the values of it. And if you go back to 14-15, our hold harmless is 13.8 million. So if our numbers change, enrollment goes down, our income goes up, and remember all the variables I showed you that detailed, if the things move wrong, we could go all the way down to $13.8 million. So there is no hold harmless other than the 13.8. Okay. It's very different than past years. Transportation subsidy, they took $50 million out of the line item, but didn't tell us what they're going to do with it. So that's me just saying, we're probably not going to get as much as last year, but I don't know what we're going to get because they haven't told us the new formula that they're going to.
So you're just watching the budget tea leaves the same as we're watching every news report about what they're going to do, what they're not going to do. You're just doing your best here to summarize that for us. Okay.
I need to do something. I'm not going to keep it where it was.
No, that's okay. I just wanted to.
Yeah.
Because that is one of the things I was going to ask you about is how are you reacting based on all those things that you see?
It's basically, we got 2 million or something last year. I put it right to 1.8, but I don't know the calculation. They're going to guess. What?
It's not a little guess.
It's a proportionate amount that I think would be $50 million to us compared to other districts. But if you said, I want to see more detail, that you're not going to see a lot of that.
That's what we're based on.
Yeah. Social Security increased as wages go up. State share of employer retirement contribution is 1.8, so you know on the other side, it went up to 3.6 this year. Federal revenues, 1,453,000. Did everyone get the email today about access and what's going on at the federal level with Medicaid? Medicaid is getting kicked out, so it's going to affect access money. We've already had some problems with it already, with getting less money than we have in the past. I dropped that from 1.2 to 900,000. So that is another one of the indications. I don't know the result of it, but we're hearing this stuff from.
Hey, just something to put in the parking lot for future thought as they start to roll through this Affordable Care Act discussion and any implications to our existing agreements. Not a question for today. Just
On our staff insurance,
how that changes as an employer and how
That's
those
employer,
changes impact.
Well, it all depends what they do with the Cadillac.
Yeah.
Tax, and it sounds like.
Yeah. So again, I don't want to discuss that. I just want to say, hey, just something for the parking lot. That's going to be something that
It's not gonna be something that
I'd be interested in at some point. Yeah. Well, that might be something we might need to be talking about.
Okay, guys, this is important to you so you understand where we are. This is our assessed value. Every taxable property in the district's listed, and that's the total amount of it. Last year, it was about $1,271,000,000. It increased by 0.71%. Now, you might think 0.71% is no good. I usually estimate 0.4%. So this is all showing me the economy is going and it's starting to improve. Real estate transfer taxes are coming in. Our assessed values have gone up more than they have in the past. This equates to $1,027,000 of higher real estate taxes. Meaning, if we did not have a tax increase and we kept it at 117.77 mils, we'd still be getting over $1 million more because the assessed value went up. Okay? So that 4.6 million you saw before, 1 million, and that's just because of the assessed value. 3.6 million is because of, I'm telling you, we need a 2.5% tax increase. Okay. This is the appropriations. You saw the expenditure side. Let's look at the appropriations. Right now, our wages went up to 110 million from 108.7, increase of $1.92 million, an increase of 1.8%. Understand that there's no retirements in it. Don't have a retirement in there. So once you get retirements in that, that number is going to drop. So is this number going to drop? Okay? Because we're going to be hiring a lower paid, younger, or less experienced teacher, and we're going to be able to take the higher wages out.
How much of that increase is new positions over contract?
Right there,
Okay.
it's there and there. And we will talk, and Christine's gonna go in a lot more detail next meeting about the staffing. We have 3 additional special ed teachers in there, and those are placeholders right now. We're gonna try to work through it, but there has been shown some need. There's 2 clerical staff members in there, and that's really a trade-off that we've already talked about with transportation. And that is another thing that's in the budget now. It's gonna be prioritized and determine what we need to do.
It's 16, so
What?
you only talked about 5 of the 15.
Yeah,
Okay.
Christine's gonna have to go over everything else.
Okay.
I will tell you, Crestwood, because of the IAs, they can flip 1 or 2 each way just because of what's going
It's
on.
okay.
Yes,
Then I wanna show you.
so before you just jump down,
Okay,
conspicuously absent is any increase in administrative headcount.
Are you getting paid for it?
He's saying that we have not expanded things.
No, I know, but this rate now is $6 million short. With the
What's your point?
2.5%, I know why, I'm sorry, speak for yourself. I'm just saying
I don't know what I want to pay for yet, but I know that we're tremendously short-staffed. I don't know what kind of benefit we could get to that.
It's been a hard decision, I would tell you. There's a big part of me that wanted to put a 1.0 in there, but knowing the reductions that we made last year, both to teaching staff as well as to support staff, and looking at where we're at overall, as we sit here, at least at this point in the budget process, we made the decision, I made the decision to keep that flat for next year. As we continue to go through the budget process, if we revisit that, we'll see. But it's just, it's to Wendy's point, you know, we're sitting here under just extremely, extremely difficult budget conditions. So as we look ahead to 17, 18, I don't see it.
Well, if there's benefit to either the educational academic performance or our ability to run more efficiently, by having the capacity to do that, I would say think about it. I can't answer that question for you, but it's a choice that should be there.
Like, I don't disagree, but I also think after this first presentation, we need to give the administration some sense of our tolerance for tax increase or not. Because that's kind of how they, I mean, this already counts for 2.5% tax increase. I don't know that this board will.
I'm just commenting as I see things. This is the first.
No, I know, but I'm just saying, like, I think it's just a direct correlation to whether the board is tolerant to raise taxes or not, so. I think it's a good, I'd like to see it, I've spoken out for it before, I think it's.
I want to point out healthcare costs. We're gonna talk about that in a little more detail, but about $2 million that is going up this year. That is with a new PBM, and I will tell you that I did get notification, and I think both associations have agreed to go with the new
Hey,
pharmacy benefit manager. I just got the second notification.
what's the savings for everybody? The shared savings for everybody?
It's $1 million for us, employer share. It's probably what, it depends on the 18%. Some people are paying, depending on what percent you pay, it'll be different with that.
That's a big win, I mean, I don't think that should, I mean, I know you have to get through the whole budget, but that's a big win.
That's great.
And it's also a year-over-year win.
Just know,
Going forward, it changed the trend, what were you saying?
oh yeah, we're gonna go over that next.
I'm
We're
sorry.
looking ahead.
All right,
But I'm not so clear. What did you say the savings for the district was on that?
$1 million, that would be $1 million higher.
And how about for the participants?
Participants get 18% if that's what they pay. There's people that pay 9%, so it depends on what you pay. That I just want to tell you, when I'm doing my forecasting going forward, you'll see I can put $1 million in as the increase, so that's double that this year. And it does concern me a little, but that is the effects one of the assumptions I put in those forecasts is $1 million there, and this is twice that. Retirement, there's the other amount that's a very big amount. And then you'll see the 300 to 900 objects, and we'll be talking specifically about what those increases are. So the total budget went up 3.95%. Go ahead. Savings for this year,
Which amount of 300 to 900 items. There are administrative supplies, but also supplies for kids, books.
books, contracts, utilities, you'll see all of them then. Well,
So that's an increase of less than 3%.
yeah, and the debt service is in there, so we're gonna talk about that too. Okay. Association with career retirements have not been considered. I am using the number of 15 retirements this year. As we look, and you're gonna see my analysis of this. I do understand that there's some feeling or something out there that I've been told that people believe there's a chance for a retirement incentive. I have no intention of coming to you guys and say I think a retirement incentive is important. It is not going to happen, and I just want to make sure people know that. And what we're going to do is be able to show that we'll be able to do this budget with 15 retirements if that's all we get. We are not looking for 30 retirements, 50 retirements, or anything. And I need that to be said publicly that there's no retirement incentive. It came to me from different ways, and I just want to make sure you guys look at me and say you agree that we're not going to do that.
15 of those a conservative number, because generally we're.
25. I will tell you right
If people are
now.
expecting an incentive, maybe they don't retire. I mean, we've looked at it 2 or 3 times in the 8 years I've been on the board. It's never feasible. So I can't see this board doing it. I don't know where that's coming from. So that's why he was conservative.
I'm not hearing that, but I mean, maybe people that are on the verge of retirement might be thinking of
It was
this.
wishful thinking.
Yeah, wishful thinking maybe, but it's
I want
not,
you to go back
that's
and
not
tell
a strong
them
rumor
that,
at all.
Can
Tell
you
them
go
that.
back and tell everybody?
They're just whispering in Bob's ear.
Yeah, I mean, we'll do that.
I'm glad that I'm wrong. But retirement contributions went up from 30.03 to 32.57. Healthcare, we used January through December 31st, 2016 experience. Medical went up 8.49%. Prescription drug is what's really inflationary, they both are, but that's twice as much, it's went up 17.05%. However, the estimated cost avoidance through the new contract makes that number go down to 4.52%, which is huge. The other thing I want to make sure you know about this contract is, unlike the other contracts where there was never an evaluation of the promises made based on the average wholesale price, this has an audit component or an evaluation component because we're in with that group, the buying group. So this will be evaluated at the end of the year to make sure that all the provisions are met. So combined, it's 7.51%. Now you're going to see it's higher on the healthcare number itself. That's the mix of where people are and what they purchased. And I will tell you, last year, for every person we cut, I took the health benefits out with these people too. Now, if we had a different mix of people, where now one person that was working 0.5 is now working a full job because they mixed together and they get benefits, that could have occurred. So that could be some of the reason too. I haven't done a detailed analysis, but there is a difference in that. And again, this year, employees are paying a little more than in past years. The premium assistance has increased. Okay. Okay, this is the 300 to 900 objects. Technology budget, we did cut the technology budget last year, and right now there's an increase of $566,000. That is for the needs of the technology department. That's going to have to go through our administrative analysis to say where are our priorities, and can we afford that, and to get rid of something else or not, because you're gonna see that we're gonna have to make some cuts. Debt service, this is the last
What
of
is the
the,
technology budget this year?
pardon me?
What is the budget this year?
Let's go to page.
I guess I can look that up.
95. It's 4.6, okay? The salary and benefits is why it looks like it's up higher, because the salary and benefits are costing more this year. But the 300 and 900 are worth the 565,000. If you see, the actual spend in 15-16 was 4 million, almost 4.1 million. Well, this current year's budget went down to 3.8 million, so you see that we did cut that in last year's, while we were cutting the budget last year. So it's been brought up again, and we'll look at that. I don't know, Matt, if you want to make any comments or not, but no.
You're doing fine.
So obviously this communications up 3,200% is a reclassification from another area.
Yeah, there was, the state came out with new budget codes, and there are some things that are showing up in my budget this year that weren't last year. So, but it's minor, but yeah, that's why that went up so high.
I like them to say $100,000 at the time.
Okay. Debt service, if you want to go to page 107, you will see that the debt service has increased. It's the last of the 3 years, $250,000 increase to fund the middle school projects.
Can I ask another question? So that feels, the salaries, 12% feels like a big increase. Is that because we have one additional staff member and then just contractual increases? Is that where it's going from?
We had some contractual increases. I know last year's budget reflected a decrease of one person. We ended up not decreasing that position, so that's an adjustment from last year's budget.
We moved that to decreasing the equipment that we purchased rather than that person. So that's the reflection there. That person might have cut and moved that around.
Okay, so it's offset software, is that what you're saying?
It's probably equipment.
It's probably split across several different areas.
Okay. Okay.
Yeah, well, equipment's up 50%.
Yeah.
So, it's okay. All right, go ahead. For me.
F75 is a new page, and I don't know if you want to look at it. I do have a feeling that Mr. Brooks will definitely want to look at it. This is the educational priorities, and this is coming out of the committed fund balance for educational priorities, and we'll read about the way we're going to spend that with diversity.
Call this the Wendy Thomas page.
Wendy, yes.
Call it the Wendy Thomas page.
Well, Wendy knows this already. She had a preview. Building and per pupil allocations, last year we cut 5% out of that, we put that back in for, that's what the buildings are on.
Why is there not a page number for that?
That is throughout the budget. That is in regular instruction, special instruction, it's in nurse's office, it's all spread out through wherever they want to spend the money. So it's, I can't just show it in one place.
You make me uncomfortable when you say where they want to spend the money. Are we dictating where they want to spend the money?
We have a representation to put votes on. Middle box, is that?
The building pupil allocation.
Oh, okay.
It is really a building-based decision.
I'm uncomfortable with that.
Well, it's somewhere in between. The amount of money is established based upon the formula that we use. And then in terms of how they spend the money at the building budget, it's principal discretion with oversight from Barry Desco, with then layered oversight by myself.
Do we ever get a report, we as the board, of how it was spent?
Not a separate report now.
Get it in the treasurer's report.
I mean, yeah, it's just, it's embedded.
But, you know, an end of year, we spend it on, how hard would that be?
I can run a report based on account code. If you want transactions.
I don't want I want to know generically where it was spent. Did we tile another foyer, or did we spend it on books or something, you know what I mean?
I can give you these specific accounts, because they're specific accounts.
After budget season, I don't want to see,
Right.
You're speaking about the building people allocations?
Yeah.
So just so we're clear,
There's not enough money in there.
exactly, we're talking about $203,000.
Knuckles.
$203,000. What's the total in that? Is that,
See, the 2 point, I should look,
is that 2.4 million?
it's, it's like 2.5 million
It's
altogether.
on that first.
Over 11,000 students.
Yeah, 1% over 15
And
buildings.
what?
Yeah, 1% over 15 buildings?
Is it 300?
Less than that?
No, it's,
Part of that.
yeah. Let me open it up.
What I'm getting at, I still want it, but what I'm getting at is, was it used to spend buy Chromebooks, or was it used for something else? I mean, are all the schools moving in the same direction, or aren't they?
No, it's not. It's every school moves differently. It's 220, it's $1 a day per student on average throughout the district.
Well, I think what might be helpful, given it's his first time through, is just an example of what a building, now, those individual building budgets are kind of in there, aren't they? Are they detailed by
No.
building or no? I mean, he might just get some benefit.
Instructions showed, but then I don't break out nursing services every school. I only have one nursing service. I have one principals, although they're broken up by school. And that's everything that you'd see.
Yeah.
I can get you that, I really can.
Yeah,
But
my-
I want you to do it after budget season.
Well,
How you gonna vote on the budget though, if you don't have the info, so it's.
Oh, okay, I just didn't want to make more work for them.
I understand, but.
I understand.
I will take it what you need, you know?
15, 16, and I will give you
It's a good question.
their budget and their actuals, and you will see the budget variances.
And not in a PDF, please.
Oh, no.
That's all.
Easy enough.
And it is $2.1 million. It was $1,900,000 in total. Elementary schools get $169 a child, middle schools get $210, and high schools get $215 a child. And that's, okay? Middle Bucks Institute of Technology increased $112,000. Our students' ADMs, the average ADMs increased by about 7, and then there's a budget increase in the total budget also, and that's what's causing that to go up. Student transportation, this is good news actually. Last year we had a big increase, and this year, $1,000 out of a $12 million budget. That's, I think, a good thing. Okay, budget summary. If you look at the first page said we were using let's say $6 million of fund balance. I'm assuming 15 professional retirements and an estimated savings of $976,000. That's net savings. There's a reduction in our state share of Social Security and retirement, as well as it is a reduction in our expenditures. That's net all of that. Educational priorities, that's a committed fund balance, so I'm saying that's fund balance we can use that's outside of our unreserved fund balance, so I'm comfortable with that. So those two adjustments are $1.2 million. I'm comfortable, as we have historically, of using $4 million, as I explained before, of fund balance, because I hope my revenues come in around 1% higher. I hope my expenditures come in about $0.01 lower, and that's what, $4 million, and I hope that continues to happen, but I am not guaranteeing.
And again, just so we're clear, that math is based on a full tax increase.
Yes,
So you're saying to deliver this budget, it's a full tax increase plus another $785.
we need to cut $785,000 out of this budget. I believe what you're going to hear from me tonight is that we are committed in working on that and prioritizing what we need to do to get it there. I am going to tell you, and I think Robert is going to agree, it'll be tough for us to be able to get deeper than that without more staff. And I want to go over that now about where we are and where we've been. And this is gonna be my strongest sales point I've probably made since I've been here. Go ahead. Why must we increase mill rate to the full 2.5%? We need to maintain the educational programs of the district at the levels of 2016-17. I'm going to show you that the levels of 16-17 aren't the levels of 2010-11. And we're going to show what's happened since 2010-11 here, but we need to keep it there. Slow the reduction of our existing fund balance. I'm going to show you some historic numbers and see where our fund balance has been and where it was last year. Continue to fund the annual capital expenditures of the district at $3 million. Going 2.5 million isn't never going to get Doug $5 million. It's not going to get him $7 million or anything like that. For a while, it's going to get him $3 million. And I can't even tell you if we keep going, I'm not sure that it's always going to be there either. But I'm going to show you all that. And I got to tell you, financial uncertainty at the state level. You know, one day they're talking about elimination of property tax. My understanding from our state association, it's off the table this year, but it's not off for good. They are going back to the drawing board to try to eliminate property taxes. And I will tell you, if they do that, I'm going to tell every one of you guys to resign, because it just will control away from you guys.
I'm way ahead.
What? Where am I headed?
Not unless we can finance the budget. If we can finance the whole budget, then we can tax for it.
You know what? If we can give them the number they need to fund it, that's great. When they give us the number that they need to fund it, we're yet to fund it, I think you lose fiscal control.
So if we don't have any control of the dollars, we can just focus on the kids, is that what you're saying?
I think you focus on the complaints.
On the complaints, that's great. That's the fun part of the job.
See the lowest point.
State budget deficit without any long-term solutions. Understand, there's a long-term functional deficit there of $2.8 billion. Governor's budget is going to address it with some one-time things. It can't keep happening. And until they address it, I can't even tell you the number we put for basic ed subsidy, for special ed, for transportation. We're going to get that. Because if they have a deficit, I'm not sure how they're going to pay us.
32.5 whatever percent retirement, is that going to go up again the
Yes.
following year? I thought we were capped at some point.
We were.
Just kidding.
It used to be 32% were capped, and we saw that. Now it looks like it's going to go to 36%.
Yeah, yeah, okay.
Ends up that much type of.
So it goes up again. Until it goes up again, yeah.
Okay, that's my strong appeal why we need the 2.5. Now I'm going to show you some financial history, and I'm going to try to explain this the best I can. 2010-11 was a year, I believe, this cycle has occurred. This is when we started having this type of cycle. The deficits from the state budget and the era money coming from the federal government started to affect us. You'll see this year our fund balance without any fund transfers is $27.9 million. 11-12 fund balance ended up going up $1.5 million. That is in the year that we reduced 60 staff members. And if you look at the tax increases, that year we didn't go up with taxes at all. Okay? 2012-13, you'll see that we moved $409,000, $4,009,000 at fund transfers. $440,000 of that was to help fund our refinancings. Remember, we were making cash contributions to the refunding, so we would reduce our long-term debt. Our fund balance went down $1.3 million, and you can follow through all this. 14-15 is where we got the extra $3 million from Lockheed Martin, and you'll see our fund balance and where it's gone. This year, $4 million to last year, $1 million of that was to fund the bond refunding. $3 million was over for capital projects, and our fund balance dropped $4.5 million, and is now at $25 million. Go ahead. Oh, you know what? Tax increases. Let's go back here. Our tax increase, I believe, over this period of time, went up like 6% altogether. If you looked at 110 to 117, maybe just over 6%, but you'll see how the increases have gone up. So that's telling part story. I know there's a lot more stories within the stories. That is just something I wanted to show you so you see the historical numbers. Go ahead. We faced challenges in 2011, 2012, and 2016, 17. 12, $14.2 million deficit, $14 million deficit, and 16, 17. Over those two periods, we reduced staff at 105.14. And I will tell you that one position, 5 positions might have been put back, and Christine will go over that more. But by and large, we are down 100 positions from the time we were in 2011 and 12. Other staff, savings affecting staff. Last year, you know what Doug did with taking the Aramark people out of the buildings, and now our staff is taking that over. This slide is just really to tell you guys that at various areas of our district, things are more stressed than they have been in the past. You hear about substitutes and not being able to fill subs and things like that. It's happening throughout the district. And I'm just telling you that I think Robert and I are saying we can't go back to reducing staff further and expect that we're going to continue to be able to have the education process that we have now. Go ahead.
And this made one for Christine. When we close Richboro Middle, there's going to be a staff reduction. I don't know how much, but that'll be something to cover at next meeting. You know, that's a year out. I get it.
No, we've already put numbers to that, and we can go over them.
No, it's fine. I just.
In the financial history, separate thought, in that time period, what has been the total change in the teacher's contribution?
I thought I had that somewhere. I might have that. Yes, I do have it in a slide. You'll see it. Here we go, right here.
Wait 1 second.
Yep.
That's fine. When we close Richboro Elementary, there'll be
No.
some potential,
No.
Richboro, what I said, my when we close Richboro Middle School, there'll be some potential savings, but I'm also looking at this number. If we have 50 now in administrative, we're down 10% to be where we are. And we've all talked about things aren't getting done. And I'll say it again, you know, like we sat here at the last, was it academic standards or something? And we looked at the special education features going on, and things aren't getting done. That's where I stood last time and opposed it last time, and opposed it this time too. So I may not be here when we close Richboro School, but we can't keep, you know, we've cut deep, I think we've made some mistakes, and I think we may have to put some of that.
I recognize that especially the kids aren't going away, so the teaching staff is not going to go away. But there's a front office staff that we don't need redundancy.
I don't need redundancy, but I need enough support.
Yeah.
Thank you.
Go to the next one. Okay.
You know, I just have to comment on that because, never mind, I'm not gonna. Never mind. Go ahead.
This is something I said.
No,
That was me.
no, it's fine.
Oh.
It's Jerry, she's very nice. It's fine.
Okay, now what I'm trying to do is I'm looking at a big scale of what has happened since 2010, 2011. That year, our budget was $199.3 million. 2016, 17 that we're in right now is $226.5 million. An increase of $27.2 million or 13.68% over 7 years. 23.8 million of that was an increase to retirement. In 2010-11, we were paying 8.65 cents for every dollar we paid in retirement. In the year we're in right now, we're paying 30.03 cents for every dollar that we pay employees.
That's the one I hope you put in the paper, Mr. Executive.
$3.4 million is what we went up in all other expenditures, which includes salaries, healthcare and other employee benefits, operations of our facilities, student transportation, instructional materials, and debt service.
That's crazy.
And that's why I asked you, could it keep going up? I mean, I'm somewhat.
Well, and so what happened actually is amazing. We looked at 3.4. A lot of those went to big tickets, healthcare, the
Yeah.
new transportation contract,
Yeah.
which we had to
And
have.
salaries went down.
Right, so basically it went there so that everything else was
Right.
pressed lower. Now, some places, we've been blessed, technology for what it is has become less expensive to deliver more breadth for less expensive. But everything else is we're doing less, we're doing more with less.
In 7 years, over 7 years, that's less than, what percentage of the budget? What, $2 million budget, and it's $4 million, so 2% of the budget for 7 years.
Right. 2% over 7 years, so people say.
Even though they were tough years,
It's
some of those
one-
years were tough years economically, so there wasn't, you could say that would be an argument, but.
It's 0.25% per year in the other figures.
Absent of fees.
Now, this is looking forward, and Mark, I gotta give you credit for this.
Thank you.
I fought this
Yeah,
all
well,
the
I tried to
way
say that.
about forecasting and everything, we did that. So I'm gonna go over this.
You should like some credit.
I would like some credit for
That's
that.
the election year.
Did you hear me?
Did you hear that, Chris?
You know what, you were right, Andy, I apologize, you did say the same thing.
Thank you.
Come on,
I was in his office first.
That's right. Andy, to Andy's credit, he said, hey, Mark's right.
You're right, Andy, I apologize, but he got on me a lot. Might have been phone calls too.
Sorry.
Go ahead, let's go.
I need to say things once.
So what I'm showing you now, and this is from the 5-year plan that I put together that we went over a couple months ago. This is the budget we're in, this is if the budget would work, and we've done in exactly expenditures and revenues. And if we move $3 million in for capital, our fund balance would go down to $7.3 million this year, and we only have $17.6 million left. Guys, I really hope revenues are above by about 1%, expenditures are down by about 1%. If that occurs in this year's budget, which is where we came to estimates, Andy, and we keep moving to $3 million, I believe our fund balance is going to go down under $3 million this year. And that's going to bring it down to $22 million. And 2 years ago, it was $29 million. If you keep carrying that forward, this is the 17-18 projection, and that's the same thing where I'm using 1% off of where my original amount is. It would be down to 19.2 million. That's the budget we are in now. Tax increase would be 2.5. 18-19 is the year of big decisions for the board. If we have no closures, you'll see what happens to our budget. And this again is the estimates off of, not the perfect budget, is if the revenues come in higher and expenditures come in lower. We cut the middle school, it's got 18.3 million if we close it, which we believe we will. If we close one middle school, elementary school, I'm not telling you which one I used, but if we close one, it would be a further increase in our fund balance. And our expenditures, as you can see, would go down even further to start next year's expenditures to be down further. Go ahead.
But following this thinking, so your first line of, we have $17 million, worst case scenario, let's put it that way. We have 17 million and we're putting in to use 4 million next year. So worst case scenario, we would be at, and then if we put another 3 million for summer projects, we'd be 7 from 7, we'd be down to $10 million on fund balance. Right, so you're
Here,
17,
show me with this.
17 million,
Yep,
okay, so follow that thinking.
Yep.
We come in on budget. Then
yep,
we go to this year, we put 400 million in the budget here, so you take 4 out of that puts it to 13. And then you
Oh, I
take
see
3 million for summer projects, so now you're down to 10. So the end of next year, in worst case scenario, just so we have would be 10 million. And I think our best case scenario is 19 million. So somewhere between 10 and 19 million, we would reasonably expect to end next year based on the budget you presented for next year.
yes.
So you're saying that that revenue number, 231.3, doesn't have the transfer in it already?
No,
No, he said, well, he puts 4 million of fund balance we'll use, but if he comes in 1% better on revenues and 1%.
So all that revenue increases is taxes and whatever economy.
yes. I see that.
So
I
we
see the number here.
don't,
That's fine.
I think, listen, I spoke for years about
And this,
decreasing the fund balance, but we do need to be realistic about where we could be next year. Between 10 million and 19 million.
In the successive year, did you, and what are your assumptions about that? I thought it was fascinating earlier in this meeting, you spoke to the fact that with the increase in the value of the property tax, we went up $1.2 billion. Are you carrying that flat in these years?
I think I carry that at 0.4.
And it's,
Our assessment value went up 0.4 rather than 0.71 this year.
right. So that, okay, so that's, I just find it fascinating. It's actually fascinating when you look at the elementary school. You save 600,000 by closing out elementary school, which is about half of what taxes go up naturally this year. I'm just looking at it saying, interesting numbers. I'm not drawing conclusions of how to use it.
Right, and this, as I said, it's interesting too, there's a solution that it should only save us money when we close a school. If we keep a school open and we close a school, we have to spend money. The
Yeah,
schools need money, one way or another. Even if you close a school, it was $900,000 or whatever, I forget the exact number of capital planning. Closing schools cost money. Ultimately, they bring in year-over-year returns, but cost money. So,
And that's what I'm just trying to understand. That's why I'm looking at it from what your assumptions were. So not, past performance does not indicate future performance, but there could be another.
I understand. Every year that we cut things, I think my budget gets a little tighter. In fact, if you go back to 2010-11, one of the reasons our 300 to 900 reduced was we used to have a $1 million fund balance reserve.
right.
Yeah, and it's no longer here. So we do so many things that are tightening things up. I will tell you that Doug's budget's at 0 this year. He's underspent his budget in past years, but that was part of the 1% that I was king in middle. Transportation was the same way. We used to always underspend their budget. But we're catching those things, and those things are going away. So I can't tell you for sure, our expenditures are always going to be under those story when you look at me thinking.
No, that's why I'm saying it could be between 10 million and 19 million. We can't count on it being 19 million.
I'm really surprised at that number for closing in elementary school, forget about middle school, that has to be a given, right? But the elementary school was surprised that it was coming at 600,000. I seem to remember twice that number being.
No, that's the one we've seen in the 5-year plan.
I think one was 600, one was 750. I think.
Yeah, it's like 1.3, 1.2 per 2.
I will tell you, you don't have the athletics, you don't have the extracurricular. When you look at the teams that will be lost by going to 2 middle schools, it's a whole new thing. The teachers, I don't have it, the efficiency is going to go up. Those teachers are going to move with the kids to another school. As you look at it, you will lose a principal, a secretary, a building maintenance person, and you'll lose those things. You don't lose the big things you lose at middle school. Okay. This is where we are, right here. Next meeting, we're gonna go over staffing. I would like to ask the board, let's the administration deal with this right now. We'll come back with an update on 4/6 to tell you where we are and what we're gonna do to get it down. 4/27, we would like to have the preliminary adoption of the budget. And then we're not approving the final budget, so we have some good time in here to decide what we're gonna do by the final budget, which is June 15th. Are you guys all in agreement with this? And I will tell you, this here is tentative. Last year, if you remember, we all came out, we put a lot of effort into it, and there's 2 people there, and we didn't get anything from the audience. I mean, from the phone calls in, or, they usually text us. And I just don't know that dog and pony show will be necessary unless you guys want it.
I think you have, in my opinion, I think that you have to do it. I think I'd rather do it, have no one show, than not do it. And
I just think that from a time standpoint, maybe we do it at 7 o'clock and board meetings at 7, or 6:30 and board meetings at 7, or whatever. We just don't hold everybody out on a different night when we haven't traditionally had a lot of people. Other than a scheduling, I personally agree with Mark, I don't know how everybody else does, I just don't think we can not offer a public forum.
It's not required for you, but you really can't not offer.
Well,
I mean, we really should.
if we're gonna vote for 0 tax increase, then I maybe feel that would be the only circumstance. If the board's gonna put any tax increase out there, I think you have to give people a chance to come talk to you.
It's good practice.
It is. Yeah.
Well, maybe we just tag it on to some other meeting that month,
I
so
would
we
agree
don't have
with
to
that.
hold people.
Yeah, I would agree.
This is the end of my presentation. Is everyone okay with where we are with this? Send in to me questions, anything as you look through the budget.
Anybody?
Anything from a typo that you find, because I'd like to catch all of them too.
I think that third meeting date, April 27th, I think is supposed to say April 20th.
Is it?
Believe me, that's
Okay,
what
I'm
you mean.
sorry.
Our board meeting is on the 20th.
Usually it's third.
You almost made it through the whole thing without apologizing once.
No,
Yeah,
because
you did 14
when you
days
put up
past.
that the revenue was only gonna be $31 million in 2 years, that was the problem.
So one of the things I think Bob had talked about it a little earlier, but you need to give some thought if you want to see what would it look like if we did a 1.5 tax. That's a typical conversation we start to have this time of year. I see the stress on Robert's face. I'm not saying you're doing it, it does mean more cuts, it's not something I'm pushing. But if you're leaning that way, I think we need to try to get that sense into the administration so that they know where to start putting the work in. I think if we get all the way to May and June, we suddenly say, oh, we're not going to approve a 2.5 and they haven't done any work, that puts even greater stress on them. So I'm not asking tonight, I'm just saying if you have some thoughts around that, you can email Bob with questions or whatever, but at the next finance meeting, we're gonna have, you don't have to commit to something, but we have to give direction to the administration.
For me, right now, looking at this and looking, for Bob's 2.5, it's not Bob's 2.5, it's not 2.5 for Bob's, right? But, at some point, if you, I think you make a compelling case for it. At some point, you get the rock over the edge of the precipice. And when that rock starts rolling downhill, that's where we lose our fund balance completely over time. It's already rolling down that hill. It's already on the incline.
The only other thing I'd like to see is, or I shouldn't say I'd like to see, I'm gonna go back and look at is the 5-year projections, because if I'm not mistaken, you had a match to the floor for the whole 5 years. You had a maximum tax increase
Yes.
every year for the next.
And maximum cap of $3 million in summer projects.
Yes.
And maximum
assumption.
cap,
Yeah.
and maximum.
Not 5 million, which is what I think.
I'm just saying what the big
Right.
assumptions.
But his assumption also was the maximum cap on Pacers was 30. So that already blew
Yeah,
out.
you have the whole deck.
Yeah, I want to show you the debt.
I thought you wanted to finish talking about this, and then we'll talk about the deck.
We can, but I sat down and I didn't have any more to do.
No, don't worry, you're all sit down. Andy, anything else? I want to give the board a chance to talk and then maybe give the public.
No, I'm gonna be particularly, I think it's a none or total. From where,
It's
what?
it's a none or total. I'm not interested in seeing a 1.5
Oh.
number for there. I'm interested in seeing the person.
It's a
zero.
It's a 0 or total, or 2.5 from where I sit. I'm interested in seeing the personnel piece in particular, and I'm interested in understanding if there's opportunity to be more efficient or to get better academic performance with more in the administration. Just remind me of the number. Somebody's probably gonna throw a pen at me for asking this. What's the bringing back the late bus? What's the number on that in the grand scheme of things?
I remember $90,000 number.
I remember that too, around there.
Yeah.
89 sounds better.
I'd like to double check that with Andy, but I believe that's the number I remember. Don't you remember that? Please.
Start thinking
Sounds
at
about
that.
right, but I don't wanna.
I can't commit to it either, but that sounds.
It's either 90 or 109. I think 109 was 9 sports, so I think it's 90.
Anybody else on the board? Anybody more? Anybody have any thoughts they want to share? Anybody in the public want to, yes?
Yeah, I'll just say that, I always start at 0 in my mind. And I will have a real hard time going above that if we're talking about spending $25 million to renovate Richboro Middle. And these other programs, these other expenses, and then still reaching out to the public for additional tax dollars. So that's my comment.
So what are you comfortable spending on this program?
I would actually like to sell Richboro Middle. If I had my druthers, I would like to see that sold, maybe to a community organization or someone in the community or the township, I don't know. But if we're really serious about closing that building and being done with it, we should sell it. It's an asset that we can realize we have enough. We have the Howell track that we really don't talk much about, until very recently about how we can use that. And we have 2 other elementary schools that we have to decide what we're going to do. And I mentioned that at the presentation. The whole presentation with Richboro Middle was assuming that we can't do anything with either Wrightstown or Rolling Hills. We can put programs in Wrightstown or Rolling Hills or both, and we decide to close them. That's my comment.
Just a question for you, and then I don't know the answer. This is one of the things I'm interested in finding out after this Monday's meeting. What if we could make money out of there? What if we could generate revenue? I don't know how realistic it is, honestly, but if we could, maybe it pays for itself and gives back to you. Don't know.
Getting out of the leases, making money, $400,000 a year.
Sure, but listen, you could move, achieve, and Sloan to a building that does not cost $25 million. You can buy a building in Newtown that's in walking distance of the stores for probably $2 million, and that's a lot of money. But that's a whole lot.
Well, what's
or to Jerry's idea of moving them into Chancellor, and you could move again. You can move the administration rights down, Rolling Hills, or whatever the case may be.
I'll put it out here. I say it publicly. It's a scheme. I'm trying to figure it out. This is what you've heard.
Of course.
No. The query was, is there a way by using private partnership to invest in the building and allow them to take tax benefit from one, to renovate this building, Chancellor Street. So that and you may disagree with the
either building, the concept, I think, is what you want to talk about.
I'm sorry.
I said
The concept.
It's conceptually would be that if this building could be empty to potentially put the administration at Chancellor. This is just it's spitball, so it's not the board recommendation, it's just thinking things out. Was if we could get someone who would invest in this building at a sum to repair it, lease it to them for $1 a year for 20 years, it all becomes a tax advantage, because what happens is, if we can do that, and then they lease the building, the property, to charities such as the ones we saw the other night, which are 501c3s, and take the difference between the market rate and the rate they would charge per square foot, and make that as a donation. If they can count that as a charitable donation, they can combine that with the depreciation of the building and use those funds as an offset to earnings and their other ongoing concerns of running a large corporation, which gets us to a point somewhere down the line that says, they could actually invest $3 million and wind up charging off to the donation of the reduction in square footage as much as $750,000 against their other earnings each year, yielding them a net benefit of $450,000. What I come to at the end of that is, we still own the building. which there seems to be a lot of people enjoy owning this building. And at the end of it, we could reclaim the building if we needed it by paying off their unappreciated portions of their improvements. It's all concept, but what it does is, we talk at the government level, we're looking at things that are public-private partnerships. How do people pay for the Virginia, pay for bridges? How do we make it work? It's total concept. If someone was good with corporate finance, please call me. I'd love to walk through this.
Can I comment on that?
Yes.
I think that is the right direction to be thinking. I'm not quite following you how someone can appreciate assets that they don't own their own business, but that's okay.
It's leasehold. That's why I need an attorney and
Right.
CMA.
Particularly when we get municipalities or school districts. But I love the idea of the community relation, somebody involved in the community. I would much rather see that conversation happen with the Richborough property, but I think it's a great direction to take.
Anyone else?
And the numbers will be bigger, that's why I was having trouble getting.
Yeah, but it doesn't matter.
If it works.
Okay, anybody in the public want to comment on the budget? Okay, we're gonna move on to our last topic.
Any chance we can take 5 minutes, is that possible?
How long do you take on this part of the class?
It's not gonna be long.
What does that mean? You got it by 9?
Yes, definitely. You okay?
I'm fine. I want to hear it, but I have to express it.
This is very similar to what you've seen before.
We can wait.
This is now, with this year's budget, we've increased our budget for debt service from 17,050,000 all the way up to 18 million to be able to provide for the 2 middle school projects. So this is the budget. As long as we stay within the green, we don't have to raise taxes for anything. Okay. Currently, this little bit.
Sorry, go ahead. But didn't you have, the funding of those projects, did you have a percentage point built in to, for tax increase every year?
Quarter.
Go back.
It was a quarter mil, I think, right?
Oh, yeah, you're right.
Yes, quarter of a mil. That's it right there.
Right. So you're saying, but you just said, as long as we're able to, we don't have to increase taxes. But this is assuming we're already raising taxes.
We did already, yes. Well,
This is
okay,
the
this is the
year.
third year.
Okay.
This is-
Yeah, this is the third year. Okay. That
So
was,
you're already building in, out of the 2.5, you, part of the 0.25% quarter increase millage, right?
Right.
yeah,
It's already built into that 2.5% increase.
yes, yeah.
You
can't
vote for that
part. Or we're not going.
I'm just clarifying.
Yeah, okay.
This is today's debt service right now. So you see all this green that we have here. And this is today's debt service. We still need to borrow $20 million for our projects, the 2 middle school projects. Go ahead, Matt. There is the structure of that debt, okay? Dr. Foster asked me on Monday night, remember he asked me, Bob, how can we do this? I want to know how much money it cost us. Go ahead, Matt. This is bringing in another 20 million. I will tell you that my answer to him was, it's an increasing interest rate environment. When PFM came back to me, they told me this is about 100 basis points higher than it was last year.
1%.
This, 1%. This here is basically interest and only $5,000 of bond principal. So this has so much sensitivity to interest rates. That's why this has occurred here, because our interest rates might have went up, our interest expense might have went up 40% because of the interest going up. Now, they have put in some conservative rates here. So we could maybe still do this.
Conservative meaning low?
High.
High.
Higher interest rates so that they're within the range and we won't be surprised.
So maybe I'm not understanding what you're saying, but I think Dr. Foster's question, I don't want to speak for him, but understanding it's borrowing $20 million for something.
Yeah.
And it's a whatever the duration of the bond is, what's the total cost of the project?
About $31 million. Okay, that's on this structure.
What, did you say that already?
No,
Okay.
just those first one I said. But that's this structure we have here. If we wanted to go and shorten the bonds, because we say we're not gonna borrow any more money, ever again, we would shorten the bonds and make that all fill in here. You see what I mean?
Yeah.
Then the interest rate's gonna be lower, and we're not gonna pay as much. You see what I'm saying?
I know, I'm just hearing $31 million or something. Got it.
This is what I
What's
want to
the
show
total
you.
cost of the middle schools? Did we ever project that?
I have it somewhere, but I can't give you a number right
I
now.
thought it was about 107 million.
I'm not giving it to you based on my schedule there, because it could be wrong. I could have stuff included in there that I'd have to do it for you specifically, and I could do that. Okay? That's where I wanted to show you where it is. If you guys want me to do this at a master capital planning meeting, I can do that. The message is, though, that interest rates have gone up. We probably have to go up another, based on this, interest rates could continue to go up. By next year, they could be up another 100 basis points.
Yeah, I'd be just to that specific question, based on the last meeting we had, I think it makes sense to figure out what we're gonna do at the elementary schools, and then look at the overall cost benefit of a smaller group of options based on potential public interest in use in those buildings, but this would be one of the inputs to what it would cost to implement that. So this is great that we have it. I don't think there's a need to bring it back until we get farther down the road.
Well,
I felt compelled to show
Yeah,
you.
that was
just
great.
things
No,
have
I'm glad that he
changed.
asked me.
The green card,
Yes,
is that?
that's budget.
Opportunity.
As long as.
No, that's, if you were budgeting to what you currently know now and everything else, that green part wouldn't exist.
Correct.
So it's really not fair to show it, because you're just showing that as continuing on. Realistically, the tax rate, I guess your column on the left, is gonna be at the top of the darker blue, dropping down as it stands now, because you don't have plans, you don't have the money, you don't have the projects that are using up the green money right now.
Correct.
Okay.
All this is depicting is that you guys don't have to say, I'm increasing taxes because of debt until we go above that. If we would go above that.
My point was,
Or
on
that's
this
fund
plan,
balance.
in 2024, there's a reduction in debt service, where it's dropping to green.
Yes,
So
we could
At
reduce
that
taxes.
point- anything, now it's like I'm channeling somebody else, but what it means is that in 2024, if we spend the money, we wouldn't have to raise taxes, but taxes would naturally fall in 2024 with regard to debt service.
Yes.
So the green really shouldn't go in at all.
But,
But
yeah.
I mean, you do have older buildings that you're gonna be
So far
borrowing.
from now, no one's going to be here.
The odds of not needing
If
to
you look
borrow.
at Doug's book of the building needs,
right,
It's still going to carry on.
right.
it's still gonna carry on. You're still gonna need to spend money to continue.
Truthfully,
to
because it's a good point, Matt, and but because of Doug's book, and then we're going 3 versus his 5.2, that green will actually be higher, because the amount of work to be done for deferred maintenance is going to be astronomical.
And technically, Jerry, to your point though, after 1819, the red is all we've committed to. So the red goes down. Technically, yeah, the purple's not approved yet, technically. Whether we use it for Richboro or we use it for something else, we have a great number of capital needs. What the money's used for might be debatable, whether we need the money or not for capital is not as debatable, in my opinion.
Matt, can you go back to the first one? Yeah, right, yeah. If the elimination of the real estate taxes and property taxes came through, we would be taxing the community and still be collecting property tax for the blue. But we'd be automatically reducing that tax around the blue. So the first year, we'd be taxing 14.77 mils. After that, we'd be dropping it down proportionately just to fit the blue.
Well, either that or we would elect to go with our projects and keep it where it is.
No,
You
you have to go to referendum to
Right,
get any
future
more.
borrowing.
More debt, really?
Yes.
That was the state plan, that was.
Yeah, that's
how that bill
the
went.
fallacy of that, which is it doesn't.
Just have you guys all report up to Harrisburg.
That plan basically gets you the Philadelphia city water infrastructure, which is, they're great to build it, back and fix it on a routine maintenance basis until it blows apart and floods the streets.
There's just actually.
Okay, any other comments, board comments,
Great work.
community comments? Okay, good job, thank you, Mr. Reinhardt.
Does everybody agree that we can do these by PDF? Does anybody really want this as paper other than when they're here? I don't want to commit him to making the binders. You can run this stuff off when we need it on paper.
Actually, on this, I kind of like, most things I like a PDF, I hate paper. Doug's book and this, sometimes I'm like spreading things out and
I said the same thing.
most things I,
Okay,
I-
finance meeting